Hi guys. Welcome to my channel. Before we get started, make sure to hit that like button. Also subscribe to my channel. Top stocks that are doing badly right now in 2023. So make sure to watch the full video. In early 2022, US prices skyrocketed amid pandemic-induced supply chain disruptions and consumer bank accounts full of cash. Remote work seemed to be here, and unemployment was at an all-time low. Many people have realized that the pandemic economic crisis is over. Not all observers were so optimistic, however, and rapidly escalating inflation has become a major headache for markets and Americans in general. After some hesitation, remember temporary inflation, the Federal Reserve has promised to curb inflation by raising interest rates. The stock market crashed and bonds exited as well, making this year a miserable year for investors as 2022 comes to a close. The S&P 500 has emerged from a bear market but remains down 17% as of this writing. Looking ahead to 2023, here are 9 investment trends that can help you separate warnings from opportunities. 1. The US is still a country with inflation of. Inflation was the economic glaring light of 2022, stuck on everything. From gas stations to grocery stores to 401ks, investors have to pay higher costs and less valuable dollars to invest in the future. The big question for 2023 is whether inflation will come down to the Fed's 2% target. Many experts think this will be impossible, although it's worth noting that the Fed's 6 rate hikes in 2022 will take time to reflect on the economy. Morningstar predicts that the Fed will ease monetary policy and cut rates to around 3% by the end of 2023. When this happens, it won't help fight inflation. This suggests that Treasury inflation-protected securities, TIPS, and I bonds should remain popular investments to fight inflation. 2. Bear market sustainability. COVID-19 stock market rocket ship crash and dissipation. June 2022 marked the second bear market since 2020, forcing investors to seek refuge. Although stocks officially came out of the bear market in the second half of 2022, the stock market continues to show double-digit declines. Bonds usually outperform bear markets, but when interest rates are raised aggressively, bond yields fall along with stock prices. In Q3 2022, the venerable 60/40 portfolio suffered a greater loss than the stock-only portfolio, leaving OG. The briefcase has to go. The next year may not be easy under traditional asset allocation models, as improving investor sentiment is likely related to lower inflation. It's never a bad idea to rotate the buy low mantra into your morning meditation playlist, but 2023 could prove that buy and hold investors need more than stocks and fixed income to brace for unpredictable markets. 3. Consider alternative investments. Speaking of broader diversification, 2023 holds promise for alternative investments finally earning a place in everyday investor portfolios. The portfolio for 2023, no matter your net worth, risk tolerance, or time horizon, should include an increased allocation to alternatives. With their low correlation to traditional asset classes like stocks and bonds, alternatives could blunt inflation and recession-induced volatility and buoy returns more than dividend stocks alone. Previously reserved for accredited investors and seasoned traders, everyday investors can easily access alternative asset strategies like commodities and managed futures through a decent selection of low-cost exchange-traded funds, ETFs, and mutual funds. While expense ratios trend higher than the average fund, the performance of alternative assets may outweigh the higher costs. 4. Savings bonds still attractive if there's any hope in the inflation cloud. It's the new popularity of savings bonds, particularly Series I savings bonds, which contrasts with the S&P's 15% decline since the beginning of the year. On Friday, October 10th, investors seeking to secure this staggering price bought $979 million worth of I bonds. On the 28th, the government bond direct website was down as it was the last day to buy before the half-year rate reset. You'd think the US Treasury was selling Taylor Swift concert tickets. For those of you looking for an alpha for some extra cash, we're in touch about a lower, but still phenomenal, price of 6. The 89% tax rate is in effect through April 30, 2023. It's hard to argue with guaranteed returns backed by Uncle Sam's total faith, even though there's no liquidity for a year after purchase. 5. Be careful with layoffs. #fired could be the hashtag of the year on social networks. Since mid-November, tens of thousands of employees have been laid off from tech giants such as Meta, Amazon, Lyft, and Twitter. While companies in the bold face a wave of job cuts, other industries have also suffered losses. Real estate startups like Better, Redfin, and Opendoor have cut staff as rising interest rates and home prices have halted mortgage applications and closed sales and corporate profits. A historically strong U.S. labor market could collapse over the next year as cash-strapped public companies seek to strengthen their balance sheets ahead of a potential recession. Experts predict there will be no shortage of job offers for new college graduates, but entry-level positions have less of an impact on a company's bottom line. Mid-career, particularly tech-related occupations, can affect unemployment rates. Companies looking to cut salaries may stick to stricter staffing protocols and leave a lot of talent behind to reassure shareholders. 6. Is encryption recovery possible? It's pretty easy to argue that 2023 should be a better year than 2022 because 2023 couldn't be worse than 2022. In 2022, several stablecoins including Terra USD and Tether lost their pegs, sparking a mid-century cryptocurrency crash that wiped out hundreds of billions of dollars. Meanwhile, crypto exchanges have suffered from growth issues and layoffs, Coinbase, not to mention the sudden collapse of FTX. As we head into 2023, look for crypto companies that will attract investors with their cool coins and non-celebrity endorsement cash holding stories, and stay tuned for major developments in cryptocurrency regulation in Washington, D.C. In mid-November, the Fed launched a 12-week central bank digital currency, CBDC, proof of concept project, and lawmakers are still thrilled to push through legislation to regulate cryptocurrencies. Unfortunately, most of the talk about blockchain is more likely to do with the FTX fiasco than with the technology's long-term untapped potential. 7. New interest in renewable energy signed $1.2 trillion infrastructure bill of 2021 and the Inflation Reduction Act of 2022 make trillions of federal investments available for renewable energy projects. While supply chain issues stymied clean energy developments from electric vehicles, EVs, to solar panels over the last 2 years, 2023 could be a very good year for renewables. With battery storage and EV adoption inextricably intertwined, BDO Global predicts a banner year for renewable energy storage systems. 8. Hybrid robo-advisors may have a moment. Recent data from Parameter Insights show that investors exited self-directed investment tools like robo-advisors and brokerage accounts at a staggering pace in 2022. Theories on the exodus abound, but two lead the charge. Wealthier investors may be flocking to traditional financial advisors, and DIers may be content to wait out a market recovery with cash in hand. No matter the reason, hybrid robo-advisors, those that offer algorithm-driven investing plus access to traditional advisors, may be teed up for a lot of interest in 2023. With consumers demanding more value for their money during inflationary times, the low-cost/expert advice behind hybrid robots hits the zeitgeist. Offering a combination of services such as automatic rebalancing and tax loss collection, access to financial advisors, and lower costs than traditional advisors, is the best of both worlds for investors who need advice but are concerned about costs. 9. Hi, TD Ameritrade. When was the last time you found a new online broker? If you are a TD Ameritrade customer, 2023 may be a good time to consider your options. Charles Schwab acquired TD Ameritrade in 2019 and the two platforms coexisted side by side until recently. This will change in 2023 and TD customers will be notified that their accounts will be migrated to the Schwab platform starting in January 2023. Jonathan Craig, Charles Schwab's head of investor services. According to Craig's note, Schwab is in no rush to migrate accounts, and clients are required to receive 3 months' notice. The move will take place over the weekend. What do you think of our video? Let me know in the comments section below. If you enjoyed this video, make sure to hit that like button. Also subscribe to our channel before you go.